How do irrevocable trusts handle capital gains? Have you ever wondered how irrevocable trusts deal with capital gains? This is an important topic in estate planning, especially when it comes to minimizing taxes and managing wealth. Let's break it down in simple terms. First, let's clarify what capital gains are. Capital gains are the profits made from selling assets like stocks, real estate, or other investments. When it comes to irrevocable trusts, capital gains are treated differently than regular income. An irrevocable trust is a legal entity that cannot be changed or terminated once it is created. This means that the assets placed in the trust are no longer owned by the person who created it, known as the grantor. Instead, the trust itself becomes the owner of those assets. Now, when capital gains are realized within an irrevocable trust, they are not considered income. Instead, they are treated as contributions to the trust's principal. This means that when the trust sells an asset and makes a profit, that profit stays within the trust and does not get distributed as income to the beneficiaries. However, it is important to note that any income generated by the trust, such as dividends or interest, is taxable at the trust level. Trusts often face higher tax rates than individuals, which can impact the overall tax burden. Recent changes by the Internal Revenue Service have also affected how capital gains are handled in irrevocable trusts. In the past, assets in trusts could receive a step-up in basis when the grantor passed away. This step-up could significantly reduce capital gains taxes when those assets were sold. However, new rules state that assets must be included in the grantor's taxable estate to qualify for this step-up. Since assets in irrevocable trusts are generally not part of the grantor's estate, they may not benefit from this tax-saving provision anymore. This change can lead to larger capital gains tax bills for beneficiaries when they sell inherited assets. Because of this, it is wise to review estate plans to ensure they align with the new IRS rules. Some individuals may consider including trust assets in their taxable estate to secure the step-up in basis for their heirs. Others might need to look into different strategies for passing on wealth, depending on the size and structure of their estate. In summary, irrevocable trusts handle capital gains by treating them as contributions to the trust's principal rather than as income. However, with the recent IRS changes, it is essential to reassess estate planning strategies to minimize tax liabilities effectively.